list that we are lucky to have. Today, we are going to be talking about the fundamentals of purchasing notes. So, disclaimer as always, Newview Trust serves as the custodian for alternative assets. We do not provide tax, legal, investment, or sell investments. But we do custody IRAs, ESAs, HSAs, 401ks that hold alternative assets that are chosen by you. We always recommend that you seek professional help when it comes to any of those items. So, what is a self directed retirement plan? Self directed retirement plan is one in which the owner directs all investment decisions, but self direction is just a marketing term, not a type of account. All IRA accounts are able to be self directed. So, what are the benefits of self direction? One of my personal favorites is investing in what you know best. They always say you're going to get the best return when you're investing in what you know best because you're able to do your own due diligence. You know the market, so you know what type of return that you're expected to get. And so you can, kind of move things around with these types of investments to make sure that you're getting the best type of investment for you. Of course, tax saving, so making the investments that you're already making outside of the IRA and being able to have the tax savings from the capital gains of these investments. And then truly diversifying your portfolio. Majority of our clients have account at a regular traditional stock bond or mutual fund custodian and have an account here at Newview where they are able to invest in these alternative assets, anything outside of the traditional stocks, bonds, and mutual funds. So, what are notes? Notes are debt instruments, also known as promissory notes. They're a written agreement between a borrower and a lender. The borrower promises to repay a specific amount of money. Repayment is made within a defined time frame, and then interest is often added to the repayment amount. So this is you becoming the bank. It's super powerful because you are able to determine what will be beneficial for you to loan out your funds or at what interest rate, at what amount of time. That's all determined by you and the borrower and whatever you guys agree upon. So, how do notes work? So, there's the issuance. A borrower requires funds and seeks a loan from a lender. That's where you could come in. The borrower and the lender negotiate the terms of the loan. Like I mentioned, whatever terms that you guys agree upon, whatever interest rate, the amount of time that you're looking for this promissory note to go for, that's all determined by you and the borrower. Once the terms are agreed upon, you'll meet with a CPA or attorney or somebody that can draw up a legal promissory note, which outlines the details of the loan. So, repayment. The borrower must make regular payments to the lender over the agreed upon term. Typically, both include principal and interest. This is really great investment vehicle, like I mentioned, because not only because you become the bank and you can loan your money at whatever terms that you guys agree upon, you can secure your investment. What that means is you can do a secured or unsecured note. So unsecured, obviously, the money is not secured, so you're loaning out the money. If the borrower defaults on for whatever reason, you would just have a worthless asset. So if you do a secured note, you will loan out your money, but you say, okay, if you default on this loan, I would like to secure this loan by the value of the property. So if you do foreclose and we're not able to get the note performing, then I will foreclose on the property and then own the property inside of my IRA. So the interest is also compensation for the lender's risks and serves as an incentive to lend the money. The interest can be fixed or variable. So maturity. The note has a specific maturity date when the full loan amount should be repaid. This can range from a few months to several years. So you can do this as long or as short as you would like this loan to be. Default. In the event the borrower fails to make the required payments on time or breaches the other terms, then there are remedies. So the lenders may have remedies available, such as foreclosure or legal action. So you can secure your money by and make sure that you're getting some type of return, whether that be if the borrower is not paying you back the money, you foreclose on the property and then pay yourself back the money by owning the property, where at that point it becomes you own that property and then you're able to either sell the property or rent it out or what have you. So secondary markets, notes can also be bought and sold in the secondary market, allowing investors to trade existing notes. This provides liquidity and potential opportunities for note investors. So this is a great opportunity or option if you're investing in a note and you're trying to get maybe another investment has come up, but all of your money is invested into this note. You can sell the note. That way, whoever is taking over that note is getting that monthly cash flow of the investment while it clears up your capital because you've sold this note to them, and now you are left with the capital and any interest payment from that, where you're able to then take that and then deploy that into your next investment. And another thing when it comes to notes is that I see people investing in all the time is tax deeds. So we have a few other classes on tax deeds, and we have one coming up next month. So make sure you stay tuned to learn more about investing in tax deeds. I'll give you a little synopsis though. Majority of people when they own, or all people when they own property, they own a certain amount of money for taxes at the end of the year, and sometimes they won't have the money to be able to pay that back. So that's where you can come in. You can buy that tax deed, loan them the money to pay their taxes, and then they pay you back. In the event that they default on the loan, you can foreclose on the property, but we'll go into a lot more detail about that in the next coming weeks. So note investing entails buying and overseeing debt instruments, so investors can earn returns through various means like regular interest payments, potential appreciation in the note's value, and acquiring distressed or non-performing notes and resolving issues with the borrower, so that way those notes become performing and you get your investment. So benefits of note investing would be steady cash flow. They provide a consistent income stream of getting those repayments back monthly or on a schedule just determined how you and the borrower agreed upon it. Diversification, so independent of stock market performance, doesn't matter whether the market's up or down. These types of investments are pretty secure. They stay at whatever percentage you went in or agreed upon in the note. It'll stay that percentage. It doesn't matter on the market. Collateral, added layer of protection. So as I mentioned, having that security or the secured note able to foreclose on the property and pay yourself back the money that you loaned is very powerful, because a majority of investments aren't secured. So, you can be investing and then the investment doesn't do good and then you're losing out on all of these monies. So it's a great investment vehicle to invest in to make sure that you are going to get some type of return. And control. You negotiate the terms. So, like I mentioned, you becoming the bank and you determining how long you want it to be, what the interest rate is going to be. I know a couple that all they do is note investing, and now they're saying they won't even loan money under 18%, which is sounds pretty good to me. Risks of note investing, so defaulting on the loan, the borrower not paying you back, that is always a risk, but that's why it's good to have a secured and unsecured option. So that way, if you do a secured, then your investment is secured. You can own something else inside of the IRA. That way, it's just not becoming worthless. And then for a secured note, it's kind of like any other investment. If anything went south or went bad with that investment, it would just be considered a worthless asset. Market risks, so due to fluctuations in the market, the notes might not be worth as much as they were a couple years ago, or they might depreciate or appreciate in value, just like property would. Interest rate risks, so market increase equals loss of value. So the more interest rates rise, you might lose the value of your performing note because the interest rates are now so high that you're not getting much of a return back. So at that point, you might want to consider selling that note. So lack of liquidity, not easily bought or sold. You do have the option to buy or sell it, but you would have to find somebody that's willing to buy that note and take over the terms of that agreement for you. Due diligence, assess market risks, legal and regulatory risks, change the structure, impact terms, or taxation. So, for these, it is very important for investors to carefully consider these benefits and risks, conduct due diligence, and seek professional help and advice before engaging in note investing. Using an IRA for note investing. So, using an individual retirement account for note investing can offer several advantages. So, tax advantages. Contributions to traditional IRAs are typically tax deductible. So, any contribution made to a traditional IRA, you would deduct that from your taxes, and then any growth inside of that account is tax deferred. So, you would not pay taxes on any of the money or any of the investments until you take the money out of the IRA as a personal distribution. Whereas in a Roth IRA, you pay the money on the contributions going in, so you don't defer them on your taxes. You pay the tax on the money that you put into the Roth. But this means whatever growth inside of this account is completely tax free. And when you're taking it out of the IRA account, it is also tax free. So, this is more of a question for you to ask yourself: do I want to be paying on the seed or do I want to pay on the crop? Asset protection. Assets in the IRA may be protected from creditors. So, say if anything happened with an investment on the inside of your IRA, there would be no way for them to come back your personal or primary residence or car or funds. You're protected from that. Diversification, potentially reduce risks and increase retirement portfolio stability. And long-term growth. Notes can generate income and eventually grow your retirement. Also, estate planning. You can facilitate the transfer of your note investments to a loved one. There are rules and regulations regarding investing in notes through an IRA, so make sure that you consult with a financial specialist to help you understand specific advantages and considerations for your individual circumstances. These are all the different types of plans that can be self-directed. Here's a traditional IRA that we already spoke about, all tax-deferred growth. Roth IRA, tax-free growth. Solo 401k is for any business owner who has no W-2 employees or common law employees. SEP IRA and Simple IRA is also for any business owner who might have a few employees that they're not looking to set up a full 401k account for, but are still looking to contribute and plan for retirement there. Specialty plans, educational savings accounts. These are great plans for anybody who has children that's looking to contribute and invest. These types of accounts for tax-free savings on any educational spending. This does not have to be college only. It can be really anything for school, laptops for school, etc. Health savings account, same idea, but for the high deductible healthcare plan. If you're somebody who has a high deductible healthcare plan, then you do qualify for the health savings account, which you can be used to make tax-free qualified health expenses. So going to the doctor, getting anything done that way. Restrictions on IRAs, no investing. There is people restrictions on who you can loan money to. So those are people restrictions, which would include any ascending or descending family members, along with any of their spouses, along with anyone you're in that business with, your CPA, fiduciary, etc. And we have a list of all of the prohibited parties we could provide. Transaction restriction. So the IRS says that you can invest in anything inside of the IRA that they don't prohibit. There's only two things that they prohibit, which is life insurance. Because if you're investing in life insurance, it's almost as if you're investing in your death, which kind of defeats the purpose of investing for retirement. And collectibles, so things like art, cars, etc. Because there's no set price on what these items are worth, you can't invest with them inside of your IRA. And then investment restrictions, like we just mentioned. So these are all of the prohibited parties. If you want to take a screenshot or photo of this, these are all of the people that your IRA cannot do business with, cannot provide services to, cannot loan money to, cannot live, work, or stay on any of the investment property owned by your IRA. These would be all the prohibited. So transaction restrictions. You cannot buy, sell, trade, loan, or extend services to your IRA directly or indirectly. And this also includes you not being able to buy, sell, trade, loan, or extend services to any of the prohibited parties mentioned here. Investment restrictions, we spoke about that already, life insurance contracts and collectibles. Real estate notes. Real estate notes, also called mortgage notes or trust deeds, involve investing in a real estate related debt. Investment options include buying existing mortgage notes from banks or individuals, originating loans secured by real estate. Notes can earn income through interest from the borrower's monthly payments or profit from selling the note. Business notes. This involves investing in small businesses or startups like private equity groups. Investment methods include direct loans to the businesses, purchasing existing business notes from lenders. Business notes may offer potentially higher returns, and they also carry a higher risk compared to real estate notes because usually with these private equity groups, these notes are not secured. They are unsecured notes, but you have the ability to make a larger return. Consumer notes. Consumer notes involves debt instruments tied to consumer loans like personal, student, or auto loans. Investors can acquire consumer notes from lenders or peer-to-peer lending platforms. There are a few websites that you would be able to visit and find notes that are out there, or like I mentioned, joining any local RIA, Real Estate Investor Association, and just keeping an ear out everywhere that you go, and getting more your network larger and more people that are in the space that you're looking to loan your money to. So these notes offer various risk levels and returns based on the borrower's credit worthiness. Performing versus non-performing notes. So performing notes, the borrower makes regular, timely payments. And non-performing notes, this means that the note is not in good standing. The borrower has fallen behind or defaulted on the payments for some reason. And they may offer higher returns, but require more effort to resolve delinquency or foreclosure. Investors can invest in both performing and non-performing notes. One reason why you might want to invest in a non-performing note is because you think that you would be able to get that note performing, which if it wasn't for you, it never would have got repaid anyway. So secured or unsecured, like we've been talking about this entire presentation, secured notes backed by collateral like real estate or assets, providing added investor protection. Unsecured note is not backed by specific collateral, relying solely on the borrower's promise to repay. Distressed debt investing. Distressed debt investing involves buying notes or debts at a substantial discount. Typically occurs when the borrower is facing financial distress. This strategy allows investors to profit from the recovery or resolution of the distressed debt. So, evaluating notes for risk factors. Make sure that you assess the borrower and all of their financial factors. You're going to look over this person, you're going to do your due diligence on the person basically, because you're going to be loaning your money and expecting and trusting that they're going to return the funds to you. So, review the collateral. Make sure that if you are collateralizing a loan, a promissory note, if you're collateralizing it by anything, make sure that whatever you're collateralizing it is something that you would want to own inside of your IRA. Because, say, for example, if you are collateralizing a loan by a piece of property and the borrower defaults on the loan and you now own this property inside of your IRA, make sure that this is something that you're going to want to own just in case, so that way you know how to move forward with that. Analyze the terms and conditions of the notes. This is why it's always important for you to meet with a CPA or attorney or somebody that really knows what they're doing when it comes to drawing up these notes, just to make sure you're in good standing when it comes to anything legal. Assess market conditions. So make sure that you're loaning out money at the market condition price and you're not doing it for too little or too much. Perform due diligence, so make sure that you do the due diligence on the type of loan that you're sending out, what the loan is for. If you are loaning it for a real estate property, does the borrower have a plan for this money that they're asking to loan? Do they have a plan? Have them share every detail that they can with you. That way you know what your money is being deployed to, and making sure that it aligns with your goals, that they're actually going to be able to pay you back. Evaluate risk factors. This is, kind of goes with everything else that we've been talking about, just knowing how to do the due diligence on the person and the note, and if you're securing it or collateralizing it, doing your due diligence on whatever you collateralize that loan by, to make sure that you either know what you're investing into, know what you're going to own in the event of foreclosure, and know what terms that you have in case you want to buy or sell this note. Calculated potential returns. Obviously, do your due diligence to see what type of return you're expected to get on this, and seek professional help. Strategies for sourcing and analyzing opportunities. So networking, going to the RIAs, as I mentioned again, any real estate investor association, trying to get around people that are in the space that you're looking to loan your money out to, networking with all of these different types of people and seeing if they know somebody, if they know a friend of a friend. Networking is super, super important when it comes to trying to find the people in the kind of space that you want to be in. Because you might not know somebody personally, but if you meet somebody, they might be looking for somebody just like you. Review payment history. So make sure that if this person if you're loaning money to this person, that you've made sure that you maybe do a credit background on these people and you review their payment history, make sure that they can make payments on time. What is their credit score? Legal considerations. Ensure proper transfer of the note. You don't want to, think that the note has been transferred and then years later to find out you're still attached to it or part of it at all. So that's why it's super important to meet with the legal experts who know, who specialize in these types of notes. Evaluate risk factors and calculate potential returns. So, investing with the IRA, there is some tax implications that might come up, which is UBIT. It is a tax imposed by income generated from activities that are not directly related to the tax-exempt purpose of the IRA. The purpose behind Unrelated business income tax is to prevent tax-exempt organizations from having an unfair advantage over regular taxable businesses. For example, if an IRA invests in a note where the borrower operates a business, the income generated is attributable to the business. It may trigger UBIT. Risk management and diversification. This is everything that we've already went over, but just to go over it again, we're going to assess the borrower creditworthiness. We're going to do a background check, maybe a credit check, collateral evaluation, evaluating the collateral in which you're securing this loan, making sure it's something that you would want to own, seeing what it's worth, diversifying across notes, so not staying in real estate notes, maybe doing personal loans to people. I've even heard of somebody needing an air conditioning unit or something to fix something on their car. So somebody has loaned them a promissory note with whatever interest rate that they've agreed upon. So even something small as $4,000 can be a note. Consider geographic diversification. So if you're doing notes, look in different states. See which markets for notes are good. See, is it real estate notes that are doing good? Is it debt? Is it private equity? And regularly monitor the performance to make sure that the notes are doing as expected. You're going to maintain adequate reserves and stay informed and up to date with these types of investments. Another tip or trick that I've seen is when you're drawing up these promissory notes is you will have an asset fee at your IRA custodian or whoever's holding the funds. Hopefully it is us. But there is an annual asset fee for holding a promissory note. So instead of you just take your IRA paying that fee, whenever you're drawing up the promissory note, including your annual fees for that investment in the note. So that way the borrower is paying your annual fees for this investment and it's collateralized. So it's a secured investment that you didn't have to pay any fees for, that your account is just growing with. So the lender's responsibilities. Once you reach an agreement with the borrower, you're going to have documents drawn up by your legal counsel, paid for by the IRA or by the borrower. Hopefully by the borrower. Suggest that you include a clause to have borrowers pay NewView fees, as I mentioned. Monitor payments made on the NewView client portal just to make sure that they're staying up to date with their payments with how you agreed. Initiate any late notices and initiate collection notices if required, paid for by the IRA. Foreclose as required. You're going to use a third party that will also be paid for with the IRA. Once the loan is paid, initiate payoff by notice signed by NewView Trust Company. We will sign that on your behalf. So things to consider: do not loan if you do not want to own. This is obviously for secured. If you do not want to own whatever you're securing the note by, do not loan the money to begin with. Pay for repairs after they are done and inspect. Do not loan unless you are willing to foreclose. If the loan goes into default, act now, don't act later. Collect interest monthly. If you are unsure about a loan, hire a professional. Get title insurance for your loan. Verify that hazard, and if necessary, flood insurance is in place, naming the lender as the insured, not the borrower. Insist on evidence that the property taxes are paid whenever they become due, and get a personal guarantee if lending to an entity. So, thank you so much for joining this class today on notes. We have a couple of note companies. If you're looking to speak with somebody about drawing up a note, we can get you in contact with people that we've worked with in the past, or you can do your own due diligence and reach out to them. Or you can, work with whoever you would like to work work with. But if you are looking to move forward and open an account, or if you're just looking to set an appointment and see if this is the right avenue for you, please scan this QR code. One of our beautiful and wonderful IRA specialists will be on standby, wanting to give you a call and talk to you about your goals. It's what we're here for, and that's what we love to do. Scan the QR code, talk to one of us. We'll fill out an application and get you to start self-directing. If you're still learning about alternative assets and you're wanting to be empowered in order to make an alternative asset, a really great opportunity that we have coming up is in October 17th and 18th. It's called Alts Conference 2024. It's all about alternative assets, whether this be inside or outside of the IRA. We're going to be inviting all current clients, prospective clients, and really anyone in the alternative asset space, so we can kind of bridge the gap on the referral partners that we work with and the clients that we service, get everyone under one roof for networking, learning, and being empowered to hopefully find your next deal, whether this be inside or outside of the IRA, and learning how to truly diversify your portfolio. David Green, he's the Bigger Pockets podcast host. He will be our keynote speaker, and we are super excited for this event, and we hope to see you guys there. And then, of course, stay up to date with us on any of our social media platforms: Instagram, Twitter, X, Facebook, TikTok, really any of them. We would love to discuss with you. We share all kinds of educational content. If you just visit our New View Trust YouTube channel, so many different learning opportunities. And then, of course, that's all for today. If you need anything, please feel free to contact us at any of these places, and we'll be happy to speak.